Hello and welcome to the GACS 2019 session on IFRIC 23. This training is on IFRIC 23, Uncertainty over Income Tax Treatments, issued by the IFRS Interpretations Committee. This was effective from 1 January 2019. We'll start with an introduction and then explain the impact of uncertainties on accounting and how uncertainties should be dealt with under IFRIC 23. Finally, we will cover the key takeaways. I am sure most of us, if not all, have come across this famous quote of Benjamin Franklin and might even agree with him. Certainty. In this world, nothing is certain but death and taxes. But that was probably true until IFRIC 23 came along and decided to change that. Paying taxes was, is, and will perhaps always continue to be certain. But accounting for taxes, as all of us have experienced, is riddled with uncertainty. And so, one needs to be prepared to deal with all possibilities, much like stepping out in unpredictable weather. There could be various kinds of uncertainties while evaluating taxes. Depending on the jurisdiction, the tax laws could lack clarity. This is often indicated by the number of legislations in the tax environment in a particular jurisdiction. There are often disputes with tax authorities around deductibility of expenses, or whether something is taxable or not, and to what extent. Transfer pricing is another area which presents significant uncertainties, primarily owing to complex and, in case of some jurisdictions, involving tax laws around this area. In a number of jurisdictions, for various reasons such as to provide a boost to a particular industry or to economically develop a particular geographical region, there can be specific tax laws which provide tax holidays or provide exemptions from revenue from certain streams of business. These could also potentially lead to disputes with tax authorities with respect to the period of such a tax holiday or an exemption or the quantum of amount which is exempt. Tax status of an entity could also lead to uncertainties, e.g. flow-through entities, non-taxable corporations, partnerships, etc. Certain kinds of transactions are also subject to uncertainties, the most common among them being leases and business combinations, primarily owing to the tax laws around them. These are just illustrative, and there could be a number of other uncertainties we have not highlighted here. Which aspects of accounting for taxes do you think will get affected by uncertainties? It should be easy to guess, since what you're seeing on the screen is the 9-step process we developed to apply IAS 12. Therefore, all you need to do is fill in the blanks. Yes, some uncertainties, such as extent of deduction or disallowance, will impact computation of current taxes, which is step 1. This is the second step, and determining the tax base could be impacted due to unclear tax laws or other issues. If there are issues in determining tax bases, it follows that calculating temporary differences will also be subject to uncertainty. The next aspect which could be affected would be the review of deductible temporary differences, as well as tax losses, particularly the extent and period which tax losses can be carried back or brought forward. And finally, some jurisdictions could have different tax rates for different kinds of income. For example, a different tax rate for capital gains as compared with the normal tax rate on other profits generated from business operations. A key aspect to remember is these uncertain tax positions have an impact on both current and deferred taxes, and uncertainties can impact any point during the tax calculation. IFRIC 23 was developed to address the diversity in practice with respect to uncertain tax positions. So why did this diversity exist? Primarily because there was no guidance in IAS 12 to deal with such situations. Let's take a look at some of the diversities. Let us start with standard to apply. IS 37 states that if another standard deals with a specific type of provision, contingent asset or contingent liability, then that other standard will apply and not IS 37. Therefore, there was a question of which standard would be referred to when dealing with tax-regulated contingent liabilities, IS 12 or IS 37. Next comes the question of how to measure the uncertainty. Given there was no guidance, entities used various methods to arrive at the best estimate: most likely amount, weighted average, cumulative probability approach. Another area of diversity was the unit of account. Since entities could have a number of uncertain tax treatments, some considered them collectively in groups, and others evaluated such uncertainty separately. IFRIC 23 provides guidance in this difficult area. Companies may need to change the current practices to follow the new guidance. So what does IFRIC 23 cover? The interpretation addresses the diversities which we have discussed, specifically determination of taxable profit, tax loss, tax bases, unused tax losses, unused tax credits and tax rates in circumstances in which there is uncertainty over income tax treatments. This interprets rather than amends IAS 12. So IFRIC 23 does not change any existing requirements of IAS 12. However, the interpretation is likely to have an impact where an entity currently uses a basis other than that prescribed in IFRIC 23. Remember, IFRIC 23 is effective from 1 January 2019. Let us look at what IFRIC 23 specifically addresses. The first issue is when to recognise an uncertain tax position, the threshold for recognition. The next is how to measure the uncertainty. As mentioned earlier, there are various methods in use currently for measuring uncertainties. The next issue is unit of account, whether to consider various uncertain positions collectively or whether we need to evaluate each one separately. The next issue is detection risk. What assumptions are made regarding the extent of knowledge of the facts and circumstances that the tax authority has with respect to the treatment. The last issue is how to consider the impact of any change in facts and circumstances on the calculation. We'll now move on to understand how IFRIC 23 deals with each of these issues. The first issue, recognition threshold. This is primarily a question of which standard should be applied for recognising taxes in the case of an uncertain tax position, IAS 12 or IAS 37. Why does it matter whether IAS 12 rather than IAS 37 is used? IAS 12 requires a threshold of probable to recognise a tax-related asset or liability. This is mentioned in IAS 12 for deferred taxes and not specifically for current taxes. However, the Interpretations Committee thought that the same threshold should be used consistently for current taxes as well. For recognition of liabilities, IAS 37 uses the same probable threshold as IAS 12. However, for recognition of assets, IAS 37 uses the virtually certain threshold, where IAS 12 uses the probable threshold. Virtually certain is a higher threshold for recognition compared to probable. Consequently, IFRIC 23 uses a probable threshold as required under IAS 12 for recognising an uncertain tax position. Let's now move on to measurement. IFRIC 23 clarifies that measurement will be based on the facts. The methods referred to in the interpretation are the most likely method and the expected value method. For some uncertain tax positions, the predicted result could be binary. This means there are only two possible outcomes. If the position is sustained, the deductions recorded in the filed tax return, i.e. 100% of the benefit, will be accepted, And if the position is lost upon challenge, none of the deductions recorded in the filed tax return, zero benefit, will be accepted. So the expected tax benefit of an uncertain tax position that has a binary outcome is either sustained or denied in its entirety. When a binary tax position qualifies for recognition, the measurement of the largest amount of the tax benefit would generally lead to 100% of the expected benefit, i.e. the filed amount, to be recorded. In contrast, where there are more than two outcomes predicted, and the possible outcomes are not concentrated on one value, then the expected value method would be more appropriate. Expected value method is what is commonly known as probability weighted average method. Here, each outcome is multiplied with the expected probability, and the results are aggregated to ascertain the expected value. Is there a policy choice when measuring an uncertainty, most likely amount, or the expected value method? No, it is not a policy choice. The entity should make an assessment of which approach will give a better prediction of the way in which the uncertainty will resolve. This will be based on the specific facts and circumstances of each case and will require the management to exercise judgment. All the examples considered so far have dealt with a single transaction. In practice, an entity is likely to have a number of situations where it encounters uncertainty, and these could be different in nature, or there could be multiple cases of the same nature. So again, this is an area of judgment, as it is not possible to have a policy or rule to determine whether uncertain positions should be analysed separately or as a group. As in the case of measurement, the approach to be used is the one that gives the better prediction of the outcome. When determining the unit of account, there are a number of factors to consider. For example, does the unit of account reflect the manner in which the entity prepares and supports tax treatments in terms of the nature of an uncertainty? What approach is used by the taxation authority to make its examination and resolve the issue? In addition, the judgment should remain consistent from one period to the next unless there is a change in facts and circumstances. Having considered what the tax authorities are expected to do, now there is a need to consider the detection risk. What does the tax authority know? Nothing, something, or everything? The assumption always needs to be that the tax authority knows every relevant fact, and if the authority has the right to examine the information that supports the position, it will do so. IFRIC 23 requires an entity to assume that the tax authority has full knowledge of all facts. So, a detection risk probability is not considered when applying IFRIC 23 to uncertain tax positions. The reference to right to examine is whether the applicable tax laws give the authority the power to examine, reopen, or investigate any past year or years. The application guidance in IFRIC 23 relating to detection risk indicates the results of any examination or actions by the tax authority will be considered as new facts and circumstances in the reassessment of uncertain tax positions. For example, these include agreement or disagreement by the tax authority with the tax treatment or similar tax treatment used by the entity, information that the tax authority has agreed or disagreed with a similar tax treatment used by another entity, and information about the amount received or paid to settle a similar tax treatment. If the tax authority's right to examine or re-examine a tax treatment expired, or if the rules changed, this will also be considered as new facts and circumstances. That is, the entity would not assume that the tax authority will re-examine them when the tax authority has no rights to do so. In all of these cases, assessment of the above factors will impact whether a judgment should be reassessed. Another aspect dealt with by IFRIC 23 is what an entity should do when there are changes in facts and circumstances. Changes could occur during the reporting period or after the reporting period end. Firstly, what would a change in facts and circumstances be? There could be a change in law, a decision by the courts which provides clarity in a previously disputed area, an acceptance of a position by a tax authority, which we discussed earlier. If this change happens during the reporting period, it will obviously need to be considered in recognition and measurement. What happens if such a change occurs after the end of the reporting period? Where a change happens after the end of the reporting period, the principles of IAS 10 relating to subsequent event accounting will need to be considered. This will be the assessment of whether the change is adjusting or non-adjusting and the consequential impact. And finally, the last two topics covered by IFRIC 23 are transition and disclosure requirements. For transition, the interpretation provides an option either to use the modified retrospective approach, not adjusting the comparative period but taking a cumulative impact in the opening balance of retained earnings, or retrospectively to all periods presented following the requirements of IAS 8. A key aspect of the transition principles is that IFRIC 23 does not allow use of hindsight when applying the provisions retrospectively. Whichever option the entity uses will need to be disclosed. Apart from the method of transition, there are no new disclosure requirements prescribed. IFRIC 23 reiterates the disclosure requirements in IAS 1 and IAS 12. As discussed, IAS 37 is relevant to the tax-related contingent liabilities or contingent assets disclosure, as paragraph 88 of IAS 12 refers to IAS 37. So, we have covered all the requirements of IFRIC 23. To summarise, will there be any impact? The answer will depend on the choices made by the entity prior to the application issue of IFRIC 23. Where the entity has followed the guidance included in the IFRIC with respect to the four aspects, recognition threshold, measurement, unit of account, and changes in facts and circumstances, then there will be no impact. However, owing to lack of guidance before the issue of IFRIC 23, there could be an impact on the financial statements. For example, entities may have used the cumulative probability approach prescribed under US GAAP for measurement of uncertain tax positions. We have completed our topics for this session. Please let us do a quick recap of the key issues. When accounting for uncertain tax positions, we have seen that uncertain tax positions accounting is specifically dealt with in IAS 12. It is likely that no significant impact will be expected if similar principles are followed for recognition and measurement of uncertain tax positions. Remember the threshold, probable, not virtually certain. That's IAS 12, not IAS 37. No detection risk. Assume the tax authority knows all the facts. The good news is that there are no new disclosure requirements, but don't forget the current ones. However, even though there is now a framework which will assist in the manner in which we will evaluate, this will continue to be an area requiring significant judgment. Today you have learnt about IFRIC 23. Thank you for listening to our video. We hope that the video has been helpful. To learn more, please visit our PwC website as well as PwC Inform.